Hi, Steph.
Hi, Tolani.
Hi, so nice to have you here. Thank you so much for agreeing to join our live webinar on finding the right investors for your startup. Thank you so much for your time, and I'm looking forward to learning all the great things from you.
Well, thanks for inviting me. I'm very excited and happy to, share a little bit of what I've learned and collected in the past few weeks and months. Yeah.
Okay, great. So let's get right into it. Can you tell us a bit about yourself? How you became the co-founder of OpenVC, and everything about your journey till we got here.
Sure, absolutely. So, well, you said it. I'm the co-founder of OpenVC, which is an online platform that allows founders, entrepreneurs to connect with investors. And the journey for me started 5 years ago. At the time, I worked at Microsoft. I worked at the startup accelerator, which means I was receiving a lot of deal flow investment opportunities on one hand, and on the other hand, I was helping startups raise funds. So I saw kind of the two sides of that workflow, and I saw that it was very inefficient. Moving forward, I've worked in several positions in France and in the US, always in between startups and VCs, and I see that problem repeatedly, and I kept looking for a solution. And at the end of that, I said, well, if nobody's doing it, then I'm going to have to build it. And so that's how last year we launched OpenVC with my friend Lucas.
Oh, that's amazing. So how's the journey been so far? Launching OpenVC. I mean, I think this is the time I should give a bit of background as to how I discovered OpenVC here. So my name is Tolani Thomas. I'm the founder at Halisi Consults, which is a consulting company that helps small businesses and startups launch, grow, and thrive. So one of the services we do is we help startups get investor ready. So we help them with their pitch decks, their financials, their business plan. So I was looking for a platform that I could easily just find the relevant venture capitalist for startups. And before that, I was using Google. I had to Google, okay, who are the venture capitalists that are interested in ed tech or agro tech or telemedicine, that kind of thing. So it was gruesome, to put it mildly. It was a difficult process. But then one day on Twitter, I just stumbled on OpenVC's page, and I was like, wow, okay, cool. And then I bookmarked it, and I was like, I'll come back to it another day. Then I think 2 weeks later, I saw someone mention how they used it and it was great. So I thought, you know what, I'm just gonna try it out. And I just went to the website, OpenVC dot I can't remember the website right
Dot
now.
app, yes.
The app,
They
yes.
didn't get the .com, so we went with that.
Yeah, but it's still great. It's still an amazing app to use. So openvc.app, and I put in the keywords for the particular startup I was looking for investors for, and voila, all the investors that that would be interested in that kind of startup just showed up on the list. It was so simple, so straightforward. I didn't expect it to be that simple. So like it was amazing. So it helped us like create a hit list for the investors I wanted to reach out to. And it was investors in Europe, in the US, and in Nigeria as well. So it was quite surprising, and I was really excited to discover it. I was like, you know what, when we have a webinar about finding investors, I have to speak to Steph. I definitely have to speak to Steph. So that's how I discovered it. So can you tell us a bit about um why you founded OpenVC exactly, so we
Yeah,
get the
yeah,
backstory.
yeah. And thank you for what you just said. I mean, super nice. I work a lot with Lucas. We work in our little spot, a bit like a tunnel. We rarely get some like live feedback like you
Feedback,
just did.
yeah.
So I really appreciate that.
Yeah.
Yeah, why we started it? Because I found it super inefficient. This process is what I call the VC discovery or the VC startup discovery. So when you look at the funding workflow from discovery to due diligence to term sheets to actual investment, the whole workflow is pretty streamlined and functioning well, except for the top of funnel, except for the first part. And it's super annoying as a founder, right? Because as a founder, you're gonna, just like you, go to Google, search, make little lists. It's very frustrating. You wasted a lot of time, and it's also frustrating on the other side for the investors, because they receive a lot of deal flow that is not relevant, that is not qualified, that is out of scope, or just really bad. And that's a kind of status quo in the industry. And most people are kind of, okay, this is how things work. And I really thought that, I think this is really the core belief behind OpenVC and why we started it, that a better way is possible. And actually, it's not that difficult, right? It doesn't require millions in funding and anything. We built OpenVC, the first version, in a few weeks, using no-code tools, using Airtable, and Lucas coded the front end. So we were like, okay, the only condition actually to make all of this work, like the whole promise, what you just described, and I'm super happy you described that way, because that's really you get what you're trying to do, so it's really nice. And there was one condition, and that condition was it has to be open and free. When you look in the past, tons of projects have tried to agglomerate and aggregate this kind of data. And most of them, in my opinion, they didn't quite succeed because they create a lot of friction. They try to charge you, they try to get you personal information or whatnot, which is perfectly fine. I mean, it's a business, and that's absolutely okay. However, if you do that, you never. In my opinion, it's never going to work at scale, because maintaining the database is going to be horrible. Having everybody on the platform is never going to happen because there's too much friction. So if you want to make it work, you have to innovate, not with the product, but with the model. And our model is a collaborative model. It's the Wikipedia model. It's open. It's 100% free for both sides. And that's why we call it OpenVC. And because we could see that perspective that, okay, if we do a simple product with an open model, we actually can make it work. This was our initial intuition. We went with that, and now it's working nicely. So that's the why.
I think it's a how will I put it? It's an amazing idea. It's such a useful tool that I think more people should find out about. And yeah, well done to you and to your team for building this platform for startup founders. So yeah, let's get right into it. Number one question on everyone's mind: what, in your opinion, is the best funding strategy for early stage startups?
So
I got right into the deep questions.
Okay, and I'll give you a very honest answer,
Yeah.
and that may not be pleasant to hear, but I think everybody needs to hear that. The best strategy is that you have already built a startup before, exited your startup for 9 figures, and then you're gonna have new investors interested. If Mark Zuckerberg or Steve Jobs, or whoever, Elon Musk, wants to start a new startup, is gonna have funding easily. And I'm saying that as a joke, but there is a message behind it. Because investors, VCs, angels, everybody, when they're looking at investment opportunities, they're gonna rank them very quickly. They have this kind of framework in their mind, which is always kind of the same. And at the top is like what kind of positive signal is there when I look at startup A versus startup B versus startup C. And the first positive signal is going to be, okay, this founder has already done that successfully. So if you're a repeat founder, that you have an exit or 2 under your belt, of course, it's going to be, a walk in the park. And then there is like several layers going below. So if you're not an exited founder, but maybe you have some, impressive resume, curriculum, you've graduated from Stanford, or you've worked at Google as a Google executive for 10 years. Okay, then you're maybe number 2. If you have none of that, however, you have a product, and your product has users, and you have a strong growth, in revenue, and you have revenue of users, then you're probably number 3 on the ranking. And then if you have none of that, then you get into murky waters, because then you're kind of asking for a bet. It's not an investment anymore; it's more of a bet. Which is fine. I mean, that's why venture capital is for. In venture capital, there's venture, so it's supposed to be a kind of adventure. But it also means that it's going to be much harder if you don't have a strong track record and/or strong product with demonstrated traction. demonstrated traction, not, we have 100 users like B2C. No, like it's actually 6 months of 30% plus month-over-month growth. That's what we're talking about if you're in SaaS, for example.
Yeah.
If you don't have that, then it's about your project. It's going to be about project. The fundamentals have to be strong. That's a given. That's going to be number one.
Yeah.
If you don't have any of those strong points, number two, it's going to be your storytelling. The narrative that you can build and how you pitch. And I mean, we discussed that, Tony. So I know you're very familiar with this. But people, you have to practice your pitch. You have to rehearse. You have to nail it. It's necessary, and if you don't do it, everybody else does it. So you're just not gonna start with a disadvantage in this competition, because it is a competition. An investor receives 10, 20, 30 pitch decks per week. They may not fund one. So, and founders sometimes don't realize that.
It's very difficult out there right now, especially with everything that's happening with the bear market in the US, because the US essentially dictates startup culture, like we discussed earlier. The US dictates startup culture globally. So with the markets being down in the US, it kind of affects funding globally. You think? Yes.
Yes. If not in fact, at least in principle, people get scared, even if they don't know why. Or I'm in France right now. I've spent the day with some big corporate clients, and they had not even heard that there's a bear market in the US, because they are in a completely different industry. They live in the small world in France, and it's just news for them. But if this keeps being repeated enough, they start going to act as if there was a bear market in France as well. So it's interesting because it's psychological, first of all. Unless of course you are you have Bitcoin, in which case it's actually a reality. If you hold a lot of Bitcoin or Luna or whatever.
Luna, that's crazy.
Yeah, but for founders, I'd say actually, and the bear market right now is more for growth stage startups. If you're Peloton, or if you're one of those companies, that may be an issue. If you're an early stage founder, actually, that may be an advantage, because a lot of growth stage funds may, look at earlier stage, and there will be, because there's a lot of layoffs right now, right? A lot of people are being made redundant in the US, so you can, snag some really good talents are gonna be available on market. And when you're small enough, you don't care. I mean, you will always find the first 100 clients. The bear market is not an excuse at very early stage, in my opinion. And
yes, but for investors, do you think the bear market is an excuse?
I mean, for sure, the bear market is going to affect how they raise money with LPs. So if you're a VC, raise money from LPs, and those LPs will be sensitive to that. But in theory, the VC is supposed to have commitments, several years ahead. So we'll see.
We'll see, exactly. We'll see. So in response to the best funding strategy for early stage startups, you said it's great that it would be great if the founder recently exited from another startup which the founder founded themselves. 9-figure startup would be great. Or they could be working with one of the big tech companies. They could be an ex-Googler, ex-Meta, or etc. Or they could have good traction already. They could have users. They could have say making some money, or they could have a good story. A good story. So I think those are the 4 major things that
So for me, it's like you need the basics, and then you have a cherry on top. So the basics are going to be the fundamentals of the company. Of course, you have to be VC fundable, which means you address a large market with a scalable solution. And that is capital efficient, right? So you're not starting a pizza restaurant, you're starting a software company or biotech company, basic stuff like that. Then you need to have great, I would say, form. And by that, I mean, your narrative, your pitch deck has to be on point. The design, for example, of your pitch deck, I mean, you need to invest in that because you're going to be judged based on that. It's weird, but that's how things work. And these are the kind of the basics. And then there's one more thing I'm going to talk about later. And then on top of that, if you have this incredible track record, for example, or incredible traction, then you're going to be in the top, 20, 30%, and it's going to be much easier for you. Otherwise, you're going to have to fight a little more. So what does it mean to fight? It means that maybe you're not going to have tier A investors. Maybe you're not going to receive funding from Sequoia or Andreessen Horowitz, but you're going to receive funding from a smaller VC firm, from like a more recent VC firm that doesn't have the prestige of the big ones. Mm-hmm. Maybe you're not going to raise with VCs, but with angels, or a combination of both. Maybe you're going to be able to raise, but with terms that are less favorable. So maybe you're going to take more dilution, this kind of things. So it's not a like yes or no answer, but it's more, are you going to raise in 2 weeks at the 50 million val with Sequoia, or are you going to struggle for 6 months, for each check? That's
but realistically, the struggle for 6 months is the reality of most startups. Let's be honest. Like I've heard stories of startups where they speak to 100 investors over the period of 1 year before they get 3 yeses. And I feel like most of these stories are not being told. Like nobody's talking about the struggle of how they finally found an investor that was willing to support them, or that find an investor that believed in what they were building. Most people are focused on the glamour of, these people, they raised 15 million USD from the US, and it looks great, but the reality of it is that the truth is that a lot of founders are more they're going to struggle more. They're going to have to spend 1 year speaking to all the investors they can find before they get a couple of yeses. So Steph, my next question to you is this: what are the mistakes that founders and entrepreneurs are making when they're approaching investors?
So many. I have a laundry list on that. So one of them, yes, is thinking that it's going to be quick. You mentioned, that it's a numbers game, and I strongly believe so. I don't know if I can share a link in your chat, but
we can share it on under the video when the video is gone up.
Okay, so I'm going to put it here as a reminder. So I like this article because this is a startup. I think it's a YC-backed startup, so they have access to network and everything. Mm-hmm. And they detail how they raised their seed round. And they still had to reach out to hundreds of investors to close $1 million. So it shows, and the numbers are there. They disclose everything. And I really like this article because I think it's really a strong. They pitched 160 investors, and they took checks from 39 people. 39 investors.
39? Isn't that diluting the equity too much?
So no, so they explain everything if you want to check out. But basically, they took a mix of small VC firms and angel investors, and they show the whole anatomy of the seed round. This is a really great article, I like it. So yeah, the thing is a number game, and also something you need to understand is most VC will say no because you need to understand that a VC firm will invest in maybe 5 or 10 companies per year, right? And they receive maybe 1,000 per year. So the numbers don't pay you a favor, and you need to be aware of that. And it's not against you. And actually, and it's something I kind of understood late in the process. When you speak to a VC, and you're going to try to pitch them your idea, there needs to be a pre-existing understanding on his or her side, meaning that you have some strong convictions about the space. Like, in edtech, there is an absolute need for a mobile-first edtech platform for plumbers. I don't know, whatever. Because the space, like edtech, and the plumbing industry, and that mobile is big, and you see how all these things come together. So you have that vision, and you're so convinced about it, and you're gonna pitch VCs, and the ones that are gonna be most receptive to you are the ones that already have some of those things in mind. So someone that has edtech experience, mobile experience, and plumbing experience, this guy's going to be able to understand you. But guess what? This guy is going to be 1 out of 100. And so it's not that your idea is bad or that the VC is dumb. It's just that if he doesn't get it, and it's super hard to convey your whole vision for a product, in 20 or 30 minutes, then it's going to be like, by the time...
It's going to be a hard sell.
Yeah, it's going to be a hard sell because you have to how can I explain it? To transmit information, transmit a lot of prerequisites before he can get your whole picture and see the same thing as you see. And that's why it's so hard. So if he already has 80% of the picture in place, it's easy to bring the final piece. And that's when it connects and says, okay, so I see what you're trying to build, and then I can evaluate if it's good or bad opportunities. But in many cases, they'll just turn you down because they don't see the picture, because that's not their space, which means you need to target very, very well the investors you're talking to. Because if you can talk to the guys who are experts in the same space as yours, it's going to save you a lot of time. You're going to have much more momentum. The conversation is going to be more interesting. And so, that's why I built OpenVC, amongst many things, because you can target better.
Yeah, I think the point you made is very valid, because you're saying that you have to target investors that are interested or have worked in your sub industry of the tech industry at large. So I think that is why that we find, especially in Nigeria, that we have so many fintech startups, more than any other sector. I think it's because most people, most VCs already have experience in finance before they become VCs, or they probably studied finance related subjects in school before they became VCs. So that kind of veers everyone towards fintech. Would you say?
Oh, I completely agree. And VC is a financial job. It's part of finance. So those guys, they have a pre-existing understanding of finance. So that's why that's what comes first. It's the same in France. You see the old generation of VCs in France, they all have a banking background or a finance background. And then some people in France built startups, had exits, and became VC themselves. Now those guys come with an operator experience, not with a financial background. So then those guys will make different investments. But the old VC generation, they are usually, most of them, finance people. And so they tend to fund finance projects.
Okay, fair enough. So my next question is this. Would you say that being part of accelerators like YC or Techstars are a prerequisite to getting funded by investors?
It can help for sure. Yeah,
okay,
that's for sure. You want to pick the right accelerator, because an accelerator has two costs. One cost is the equity they're going to take. So you don't want to be diluted too much. Some accelerators will take 3%, some 5%, some 7%, some less, some more. So that's the first cost. Sometimes there are like public funding accelerators, so it's free. So that's cool if you can access that. But then there's another cost, which is the time it's going to take from you and the defocus. I have known many accelerators. Sometimes they are heavily government funded, so they don't really care about being efficient, and they will waste your time with useless workshops and training sessions, and they will not really create value, in my opinion, and they will actually expect you to be present in person and these kind of things because it looks good for them to have a full workspace, open space. So you want to do your due diligence ahead of time and make sure that if you join an accelerator. So you want one. I usually say go for a specialized one. So if you're in biotech, you're on the biotech accelerator because they're going to be much more relevant. And they're going to know the investors in your space. They're going to provide you better support and the community, because an accelerator has a community of alumni. So if they are in the same space, they can be much more helpful.
Okay.
And then second, make sure, you're not gonna waste your equity on this, basically.
Yeah, that's a very valid point.
Sorry, I talk too much.
No, it's fine. It's very helpful. You're giving a lot of tips that most people are yet to realize, and this webinar is set up to help people get to the point where they succeed faster. So please talk as much as you can. So yeah, what you're saying is really valid, because I actually had a meeting earlier today with a founder, and then he said that he joined an accelerator. He's building a mobility tech startup, and he joined an accelerator, and halfway through he realized that the accelerator was focused on agri-tech, and it was it was painful for him that he had to leave the accelerator at the end of the day, because they weren't really helping as much as he would have wanted. So this is very valid, that you have to do your research and know that the accelerator aligns with what you're building. So I think my next question would be about VCs and angel investors. So in my experience, especially in Nigeria, as much as angel investors say they want to come in at the idea stage, the reality of it is that they still want to see a bit of traction. So what's your experience with angel investing? What's your experience with VC? Which one is it better for you to just go straight to the VCs or to try, hitting up a few angel investors and see if they'll write some checks? What do you think?
Okay.
Hard question, I
So
know.
I think, no, I think it's a great question. There's a lot to say. So number one, you don't get to decide. Money is money. And if you're a first-time
Mhm.
founder and you don't get to pick, so you talk to angels, you talk to VCs, and you see what sticks. Again, it's the number game, so why restrict yourself to VCs if they're angels? Number two, it's not either or. You see more and more mixed rounds with a combination of VC firms and angels. So it's okay to have a mix of both. And you should actually, let's say you want to raise, I don't know, $1 million. You can, start collecting checks or at least commitments from smaller angels. And then when you have 200-300K of angels, now you can cold email VCs, for example, if you have no intros, and tell them, hey, I have already 30% secured of this round. So would you like to consider? And then it's more exciting for them than, hey, I'm just starting, I have zero commitment. And part of, I said I would leave something for later, so that's this part. In how you approach your fundraising strategy, you want to start with the path of least resistance. So you want to start, so if you take like all the investors you want to talk to, right, line them up, and you put the ones that are most likely to say yes at the top, and then you go down to the ones that are most likely to say no. And because what you need is you need to create momentum. So you need to speak with an investor, and then he says yes. And then you go to the next one, who is a bit less friendly, and you say, but the first one said yes, so he's going to say yes. And then you kind of create that chain where one out of three will say, but you need to have some wins at the beginning, so the next guy has basically some
More
positive
likely
signal.
to say yes.
Yeah, I mentioned positive signal. So if you don't have one, you create one. How do you create one? By having the first few yeses, and then you go. So maybe the first yeses are like family and friends, right? And then the next yeses are going to be some, let's say, smaller angels, right? And when you have that, then you can go to bigger angels that have a bigger name, for example, that have a reputation in your space. Then, hey, I'm raising this, are you in? So the guy's going to say it. Then you can go to VC firm and say, hey, I have this famous angel who committed on the cap table. So you can create a momentum, and so that's part of the answer. And you asked about, are they fast, are they slow? There's a big difference between individual angels and angel networks, or angel clubs.
Yeah.
I don't know how it is in Nigeria, but in France, sometimes angel clubs are more like basically people who made a lot of money and they want tax breaks, and they are a bit bored on Sundays or on Saturdays. So they go to those startup pitches, and they're going to invest, and they kind of let the manager of the club invest for them. And then when they go golfing, they're going to say, oh, I've invested in these little guys, they're doing tech company. So they're not going to bring much value. They're going to be slow. They sometimes be worried, a bit too worried, they're not really. But again, money is money. So if you don't have any better, go for it. If it's your first startup, done is better than perfect. And
Yeah.
I think it's
I
also
agree.
true for fundraising. So
Yeah.
get what you
I
can.
agree completely.
Yeah. You're not in a position to be picky. Of course, it's very different again once you have a track record or some traction.
Yeah.
Yeah, and you mentioned, angels say they invest at idea stage. This is
Not really the
the main thing.
reality. Yeah,
Not a
my
reality.
experience with angels. I've spoken to a few angel investors in Nigeria. As much as they want to come in on the pre-seed, they say they invest at the idea stage, but that's not 100% true. Some angels do, but those angels are actually really rare to find. And angels that do invest at your idea stage are investing because of your clout, or if you have a reputation in your industry
Exactly.
already, you have a track record, you have good storytelling, and they've been watching you build in public already, so it's easier for them to write a check for you because they've sort of known you already, and it's kind of like an old boys club. They know that, oh, this person is going to build a great startup anyway, so they're happy to write a check. But if you're an unknown person coming from God knows where you don't have any PR, you don't have a lot of
You're
experience
nobody.
with.
You're just someone coming for
Exactly.
money.
You had to work twice as hard. Then you had to go and get some traction and have some user, a lot of users, thousands of users literally. And your recurring revenue has to be skyrocketing literally before you can see some checks. So I think that would lead me to my next question is, what do you, in your experience, what have you seen that has worked in securing the first check from venture capitalists?
Okay.
What works?
So I've seen one thing that works. It's that
Right.
you keep your day job, you build your startup on the side, right? Until you reach that position where you make, let's say, $5,000 a month, if maybe less in Nigeria, I don't know, but whatever makes you self-sufficient, makes you break even, like you can pay yourself. So if you're like in the US, maybe it's 5,000, maybe in France it's 3,000. I don't know how much it is in Nigeria. And make sure you have something, which is hard
Yeah.
because you have to do two jobs, right? You work at the office and then you work at home, or you do some consulting on the side, whatever. You bootstrap basically, and then you're in a good position to raise funding because you have a product, you have some users, you have de-risked the project. You're doing that by choice. But basically, starting a company doesn't start with raising funds. You don't say, okay, I want to start a company. I want to start a startup. I want to build the next Uber for Nigeria. So I need to pitch deck. I need to raise funds. It doesn't work. You have to go as far as you can on your own, and then potentially raise funds. But that's an option. That's not the only path. And I see, and specifically at OpenVC, we have a lot of deal flow from emerging markets, Africa, Southeast Asia, Latin America. And sometimes I see this kind of misunderstanding when the founders don't get that there's kind of process, And when VCs say we invest in, or angels, we invest in ideas, what they mean is we invest in ideas if you've already had $1 billion exit with your previous company. Not if you're a stranger with a half-cooked pitch deck, or half-baked. Sorry.
Yeah. I got you. I mean, it's really difficult because if you don't have that, reputation and that name, it's harder for you to secure those checks. But it does happen. It happens in some cases. Yeah. So I'm very happy you mentioned deal flows that you've seen, based on your work with OpenVC. So can you clue us in on the trends that you're seeing based on the deal flows that you're seeing from Latin America, Africa, Europe, everywhere?
Yeah.
What are the trends? What predictions do you have for the next 2 to 5 years when it comes to startups and raising?
Okay, so predictions, I don't know. I'm not good at predictions. I'm more of a maker than a visionary. What I see is that I see really good stuff, to be honest. I've seen some really good stuff in the past months from Pakistan. I don't know why. I guess somebody shared the OpenVC link on the Pakistani group of excellent founders, and we
Wow,
received
that's
like 3,
amazing.
4, 5 super good deals. Super strong stuff. And interestingly enough, they don't ask much money. I think those guys, they build hard, they get to growth to like some serious traction. They're raising a reasonable amount of money. So that's probably interesting for VCs because they can get better valuations, than what they could get in the US. The market is less competitive, and you can still build some really fundamental businesses there. Some infrastructure businesses that are like generational winners. So that's number one. In Africa specifically, well, I think Nigeria is like a trend in itself. By far, that's when I look at the countries where people comes from in Africa, Nigeria is like
the biggest.
Yeah, definitely. And then when you look at the founder profiles, you have a lot of returnees, Nigerian people who went and worked or studied abroad and come back to Nigeria, and they come with their knowledge, with their insights, with their experience, and they kind of build a local ecosystem. So that's really interesting how they borrow from outside and bring it home. Latin America, I've seen cool stuff in Mexico, and then from time to time something really good coming out of Argentina, Chile, but it's still from time to time still occasional. And then again, our deal flow is we don't see everything. We see a fair amount of deals, but That's just what I
Okay,
see.
it's interesting. So, you mentioned that based on what you've seen, looking at the founders' profiles, founders that have experience studying abroad or working abroad have more success than founders that are homegrown, like founders that are from the country where startup is based. Like for example, Nigerian founders born, raised, schooled in Nigeria. Um, the ones that travel abroad and come back have better chances of making it. At what point do you think that we can say the same for homegrown founders? I know we've discussed this before in
Yeah,
private, but I just wanted to put it out there. What point do you think it's not just gonna be founders that have international experience that are successful, but also founders that are 100% homegrown from, say, Nigeria. Yeah.
yeah. At the end of the day, startups is a talent game. So you need
Mm.
talent. So now, what do we mean with talent? Talent is not raw talent. It's not just people with energy and grit. That's necessary for sure. But you also need people who have experienced, learned, practiced, walked the walk, and who kind of know the playbook.
Hmm.
I'm French, and I've spent a couple of years in the San Francisco Bay Area, so Silicon Valley, all that stuff.
Silicon Valley.
Yeah, exactly. And I noticed something is there's a kind of profile of startup executives that I never really saw in France. These are guys that are 40, 50-year-old who've worked in 4, 5, 6, 7 top startups. When I say startups with valuation, $100 million plus, $1 billion plus, scaled the startups, and jump startups, so they come right after Series A
Unicorn
or
status
Series.
startups.
Yeah, they joined the startup at Series A or Series B, and they stay there for 2 years. They set up, let's say, all the growth engine, marketing, sales with their own little team. They set up on the rails for IPO, and then they move on to the next one. And 4 years later, 5 years later, startup IPO, and they take their carry. So, and those guys, they are a tremendous asset. Like they know stuff, they have done stuff, and repeatedly proven success. So it's not so much a matter of homegrown or not homegrown. It's more a matter of, can you get that experience where you live? And in France, for example, for a long time it was not possible either, because we have no IPO. Like even if you want a CFO that has IPO experience to IPO your own startup, well, where is he going to get that experience? Because we don't have, for a long time we had no IPO, and still now it's very, very rare. Well, in the US, you have
So,
several.
sorry, in France, there's no startup that IPO'd, even if it was London Stock Exchange market, not necessarily
Yes, but not
the
in the same volumes.
France's version.
Not in the same volumes as in the US. It's not as frequent.
Yeah.
So you don't
Yeah.
have as many learning opportunities. Because for the startups, going through growth and IPO or exit or acquisition, whatever, this is for all the people in that startup, it's a learning opportunity.
Yeah.
And when they leave that startup and they go start their own startup or join another startup, they bring that experience with them and they can replicate that. And so it's a continuous process. And the question is, how do you get people to acquire that experience the first time? And if your local ecosystem doesn't have this engine of startup, scale up, exits, rinse and repeat, then you don't grow that talent locally. So if you don't grow it locally, either you send your people abroad to learn that, or you bring experienced people into your country.
Into the country, yeah.
So
Yeah.
that's.
I think we've been seeing a bit of that in Nigeria already, where founders that have international experience move back to Nigeria, found startups and people that work with them, that homegrown talents that work with them, then go on to build their own startups as well, or go on to work for bigger startups. So I think that trend has sort of started. So the Nigerian tech ecosystem has sort of started, how I say it, growing the second generation of founders that are ex um, um, growth manager or finance person, etc., operations manager in other startups. So they are going ahead to start their own startups. So yeah, I think we're starting to see that. And it's really exciting. That is happening already. It shows a lot of growth potential for us in Nigeria, but all the same, we're still having a lot of disconnect with founders that I wouldn't really say I don't want to 100% call all of them founders. I'll say entrepreneurs that are venturing into the startup space. So there are a lot of entrepreneurs that are probably coming from traditional businesses that are trying to get into the startup space, and they're finding it difficult to acclimatize to that's startup culture is completely different
Yeah.
than traditional business. So are there any tips that you can give for entrepreneurs that are becoming founders of startup founders, and how they can sort of embody that founder mindset and use that to approach investors?
Yeah. So it's interesting you're saying that. So my father is also an entrepreneur, but
Amazing. Same
of
here.
a typical business. He was a hotel owner, small hotel owner, and so he's more of a traditional business person, and I'm more of a tech person, and there are definitely differences. And it's funny because when I talk with him about what I do, he doesn't really get it. He doesn't get why I do the things the way I do them. Why do you need to raise funds? Why are you not taking good salary when you could out of the value you've created? Uh, you know, why a company like WhatsApp is worth so much, when they got acquired,
Yeah.
although they don't make any revenue. It doesn't make sense for him because
Yeah.
it's not the same playbook. You're not playing the same game, and so it's. I'm not going to explain everything, of course. I
We don't
mean,
have
it's
time.
part of the homework. If you want to start a startup, you do your homework. That's what I
You have
always
to do the
repeat,
homework,
right?
yes.
There is tons and tons and tons of great content. I always recommend the Startup School by Y Combinator, which is free. It's on YouTube. Just go to Startup School and watch all the videos and take notes. So that's, I think, if you don't do that, don't even start. If you cannot put in a few hours just to learn the basics, when you have such great resource at hand, you have to be demanding with yourself. Okay, now that we've said that, the big difference for me is that on the one hand, you have cash flow businesses. So if you have a
Yeah.
hotel, a restaurant, a plumbing business, it's a cash flow business, right? What you want to do is extract as much cash out of the business of the cash flow every year to pay yourself a nice salary as high as possible. When you start a startup, it's an equity business. It's not a cash flow business. So the game here is you don't really care about cash flow because you're funded, or in theory, you get funded. What you want is you want to grow as much as possible in terms of users and revenue, even if it's inefficient, even if you're gonna completely burn your margins. You don't care because what matters is growth at all costs, because then you're growing your equity value, and eventually you're going for an exit. So the moment where you make money is not the same. You're not making a little bit of money every year, making everything, almost everything, once you exit. And this drives the whole differences
Yes.
in how you approach your business, how you hire, how you go to market. You're much more aggressive, you take more risks, and it's kind of all or nothing game. So you're entirely correct. It's different mindsets, and you need to learn that, and you learn that by speaking with people, reading, watching videos, all this stuff.
So, are there any other, aside you recommended Startup School by YC? Are there any other podcasts that you can recommend that would give people insights on, embodying the founder's mindsets that you need to have when you're speaking to investors or just building your startup generally?
Yeah, there's a ton. Twitter. I mean, go to Twitter
That's a good one.
because
I
Twitter
found
is,
you on Twitter, so that's a very good
yeah.
one.
Well, I don't know. I mean, there's me. There's other people on Twitter, but Twitter is great because it's kind of a gateway to other resources. So
Yeah,
if you follow
I
the right
agree.
people on Twitter, and on Twitter, everybody wants to sound smart, and actually, a lot of people are pretty smart. And so, if you follow the right people, you're gonna have nuggets of their thoughts and mindsets, available every day. And then they share some links. You can visit the links. So if you want something, just follow the right people on Twitter.
Yeah.
People are, active in your space with a lot of followers. It's easy to find lists, and that's your starting
Okay.
point. And then go there every day and learn and learn.
Brilliant. Thank you so much for that. So we have one question here. So I'm gonna just switch to questions and then we start to round up. Um, Yes. Hi. Nifemi Ojo says, "Hi. Got any advice for clean energy startups?" So have you seen any trends or deal flows when it comes to the clean energy space?
Yeah. I've seen a few. I would say it's both easier and harder. So on the one hand, it's easier because clean energy is hot in general. Green startups are hot. It's a topic that people want to invest in. So a lot of VCs will, for example, invest only in clean energy or allocate some money especially for that. So that gives you a kind of space in which you can play. You also can access grants, and subsidies, and usually, I don't know in Nigeria, but you have some free money that you can get, so that's for the plus side. The downside is that usually clean energy startups is hardware, and hardware is 10 times harder than software. When you build, if you want, for example, to just get a prototype out with software, you just need prototyping software, like
Yes.
Figma, whatever. It can be done in 2 weeks. You can learn it yourself. I built the first prototype for OpenVC on Google Slides. And I still,
Wow.
because for all the mockups, all the designs, I built it on Google Slides because I'm not a tech guy. So that's better. I did consulting, so I know how to use PowerPoint and Google. But if you do hardware, you're going to need capital up front. So the kind of first step is much higher, in my opinion. The first step is much higher. So it's really, hardware is a bitch. Hardware is hard as hell. And so specific advice, I mean, it's not a space I'm very familiar with, so I cannot give very specific advice.
Specific advice.
But just keep in mind that it's even harder than software, but that you can rely on some, communities and funding that is specialized in that space, clean energy. So you should really try to focus on that. Join some groups.
Yeah, community is very important generally for any startup sector, even if it's fintech, edtech, clean tech, same. Another thing that I want to mention is, if you have a startup, you can just go to openvc.app and you can type in all your keywords. I don't know why you didn't say that, Steph. So you can type in all your keywords and find the investors that will be interested in your startup. And OpenVC would aggregate a list for you of maybe like 10, 20 investors that would be interested in your space, and you can look at each of them one by one. You also have the option of submitting your pitch deck if you have one, through OpenVC, if the VC is if the venture capitalist is already verified. If you don't have a pitch deck, you can always reach out to us at Halisi Consults. We can help you with that. If you need some advice, some guidance, we're here for you. But anyway, any investor, any type of startup that you're running, you can always go to OpenVC to look at the investors that are interested in that particular field. So yeah, you can do community, you can learn as much as you can, and do all those extra tips that Steph has said. So yeah, that's it.
Actually, I've been trying to think about more advice. I can give maybe 2 little ones. One is clean energy, everything around green tech. In fact, is great, but that's not enough to build a business. So even though you're in a space that you care about that has a mission and a purpose, it's still a business. So you still need to show return on investment, profitability, growth, market size, all that stuff. It's not enough to have a big vision how you're going to make the world cleaner. And you need to quantify and show that it can be a profitable business too. You cannot just hide behind the greenwashing and expect that it's going to work. So that's one. And the second one is that in those industries like energy, biotech, hardware, usually you're expected to have some advisors that are experts in your space. So we don't expect that really with software startups, not that much. But usually if you can have a professor who, a big name, or a scientific advisor or two, you have a board of advisors on your pitch deck, and they lend you some credibility, that usually helps. And they also can actually help you with your project.
Okay, that's interesting. Funny that you mentioned advisors. Do you, by any chance, take on startups advisory positions? Like be on the board of a startup's advisors. Is that something that you do?
I don't advise. I don't invest, and the reason I don't is because I don't have time, really. And the little time I have is I build OpenVC, and my way to help everybody is through OpenVC. We have the product, the app that you guys can try. We also have a blog where we try to publish very helpful articles. So I can give you an exclusive right now. Next week, we're publishing an article that is a kind of collection of the best cold emails sent to VCs. Because usually, when you're cold email VC, you want an example, a template, or whatever. So we have collected
That's amazing.
many of them, and you have all of them lined up, so you can find inspiration. And that's our way to help.
Well
so I
done.
cannot spend more time, doing more things. I try to help
you
at
have
scale.
you have to play your part in the startup ecosystem. So this is what you're doing to help, and that's amazing. Everybody has their part to play, and thank you so much for that. So Nifemi has a question again. If you have built a prototype that already works,
So I guess
yeah,
that's the continuation of his first
of his first
sentence.
question about clean energy startups.
So if you have a prototype, you have to demonstrate. So usually in clean energy, let's say you're building solar panels that have higher ROI than typically current technology. But you want to so you have your prototype, then you need to demonstrate the actual ROI or whatever. So if you're in biotech and you can produce more cells, more proteins per cell, you want to demonstrate that. So you want to calculate that. And then you're going to need someone on the business side. So I don't know if you're a tech guy, Nifemi, or a business guy, but you're going to need a team. I answered the question, apparently. Wonderful.
Great.
But yeah, if you have a prototype alone is worth nothing. What's valuable is a prototype that demonstrates that you can hit the metrics or the promise. So your promise is, I'm going to 10x the productivity of solar panels. You want to demonstrate, okay, we've done that repeatedly with 2, 3, 5 clients. You do pilots. So if you have a prototype, you can go to pilot clients and you sign a pilot agreement. You do a 2 months, 3 months run for half the price. You charge them. You never do a pilot for free. And you prove that. And then, 3 months from now, you have a pilot. You have actual results. And you have a few big logos that you can put on the website. And then those maybe pilot clients can become your first angel investors.
That's interesting. I've actually seen that before, where a startup was pitching to B2B clients, and then a client actually offered to invest in the startup. So yeah, valid. It absolutely happens all the time. So yeah, you never know. You never know where money is going to come from, because money is money. So it could actually be your customers, and not maybe an angel investor at the end of the day that gives you your first check. So yeah, that's a great tip. Thank you so much, Steph.
Sure.
So, I have one final question before we round up. Most people don't really understand how VCs work, and they feel like there's a lot of bad blood, if I may say. When a VC says no to writing a check for a startup, they feel like, okay, maybe the VC isn't interested. So can we just have like a 1 minute, 2 minute breakdown of how VCs work, to clarify for founders, so when they're approaching VCs, they come from a clearer point of view and they see them as humans as well?
Okay. Very simply, and that's a great question, actually. I always recommend founders to understand how VCs work, so they understand what's happening behind the curtain. In 1 minute, the VCs don't invest their own money. They invest somebody else's money. So this somebody else, we're going to call them LPs. So LPs have $1 billion, and they're going to fund the VCs, and the VCs are going to have maybe $100 million to invest in startups, $1 million or $10 million. So it's kind of there are kind of 3 layers in that game. So that's number one. And the VCs usually have a time commitment. So they tell the LPs, okay, we take your money now, and in 10 years, we're going to see the results. So 10 years is the fund's lifetime. So the fund has a life duration, has a start and an end. And usually the first 2 years of the fund, they're actually talking to LPs and getting the money in. Once they have the money, they're going to invest for, let's say, 4, 5, 6 years, right? So
Yeah.
from year 2, 3 to year 5, 6, they're going to make the investments, and then the follow-on, because when a fund invests, if you're doing well, they want to invest in the next round as well to increase their exposure to success, right? And then the last 4 years of the funds, usually they're just, winging it. I mean, there's not much work to do. You just wait until your startup exits. Hopefully, you help
Yeah.
them exit if you can connect them with, buyers, for example, corporate buyers.
Yeah.
But that's how it works. So a VC firm follows a kind of very defined timeline, and so they're going to invest in you. Usually, they are in their year 3, 4, 5, something like that. And they need to exit by year 10. So if you're a bit too slow to grow and to exit,
Year 10. Oh, wow.
that's not a hard
very
goal.
far out.
Yeah, but that's how they work. And then what happens is that, let's say a VC has started a fund, is doing well, he's reached year 6. What's he going to do the last 4 years? He's not going to just wait sitting in a couch. He's going to start another fund. So VCs, actually a VC firm, has several funds.
Yes.
They're
yes.
all like stacked, and maybe there's like 5 years difference between each. So if the first fund works well, or it seems to work well, because you don't know the results until 10 years later. But if it seemed to be working well, then they're going to be able to raise this fund 2, then fund 3, then fund 4. And that's what we call fund generations. So usually, and it's actually super hard, by the way, that for all the founders listening, it's super hard to start a VC fund. Much harder than to raise money for a startup. It's hard to raise money from VCs, but it's harder to raise money from LPs. Because if there are maybe 10,000 VC firms in the world, there's maybe 1,000 LPs or whatever. So having said that, the VCs are gonna kind of stack their funds, and you're gonna show up at some point in their lifetime. But you have to understand that it's like a three. How do you say in English? It's like 3 parties dance.
Love
right?
triangle.
Yeah, it's a love triangle or whatever.
Yeah. So that's a very great tip. I'm gonna share some examples. I know there's a particular VC that's quite popular in the tech ecosystem in Nigeria, and it's a lady. She said that she had to speak to 300 plus potential investors before she got her first few checks to run her fund. And a lot of people feel like, oh, it's easy, but her sharing that story, I think, was it 360 plus people that she spoke to before she got a few checks. Then she could then take those checks and invest in startups in Nigeria. And luckily for her, she was one of the people that invested in Paystack. Paystack is one of the biggest success stories out of Nigeria. So Paystack has been running for, I think, 7 years now. They started the company, and 5 years later they sold it to Stripe for $200 million. I think that's a perfect exit strategy, in my opinion. This is going to lead me to the final question before we round off. Steph, are you more of the opinion that startups should sell to bigger startups, or they should IPO?
So obviously, I mean, if you do that, I mean, usually if you start a startup, it's you go big or go home, right? So you're gonna try to IPO, but that's again same answer as before. You don't get to pick. I read a really good article. I think it was by Jason Lemkin, but I'm not sure. Great, by the way, good resource. Jason Lemkin, SaaStr, fantastic, the #1 resource for SaaS companies.
Okay.
And he said basically, if the startup is doing well, you have no reason to sell. And so usually if the founders are going to be willing to sell at some point, it's going to be because either personal reasons, problems happen, or they don't see the path and what they want to achieve is doable anymore. Maybe the market conditions have changed, maybe technology, whatever. And so if you sell the company, in his opinion, but I'm not sure it was from him, the article, it basically means that it's kind of, loss, but it can be great from a founder perspective. It can be life changing. And actually, what you have to think about is not do I sell or do I IPO or whatever. It's personally as a founder, what's your life direction? As a founder, you don't have one company. You're going to have several companies in your life. So you may start a first company, sell it for $20 million, within like 4 or 5 years. It's a small exit. You're not a billionaire. Doesn't matter. Now you're in a position to start a new company with all the credibility, the cash, the network, the experience you've accumulated. That's going to be 10x what the previous one was. So it's not a one-time game, right? You're playing a long-term game, and you're not building one company. You're building yourself as an entrepreneur, as a founder, and the ability to replicate success over time. It's very rare that your first company is going to be Google or Facebook.
Yeah, I agree with you to an extent. But there's a great comment here from Oluwakemi. So Kemi says, I think African companies are more likely to sell due to geographical limitations in scaling globally. So in Africa, we have, scaling issues. I don't know if you saw on Twitter about, I think 2 months ago, where the Bank of Startups Mercury locked out everyone.
I
And
heard that.
yeah, it was a big problem. So sometimes it's just, if you want to have like global domination, for us Africans, it might just be easier to sell and just have some equity left in the company. So you're still a co-founder, you're still working for the company, but you sold it to a bigger company. So
I agree.
yeah,
I
sort of
truly
like what
believe,
Instagram did with Facebook. Yeah.
I believe you have what I call satellite master ecosystems and satellite
Yes.
ecosystems. So if you're in the US, you're in a master ecosystem, and you're basically bound to extend by acquiring other little guys, to complement your offering. It's very rare that a Spanish or Nigerian startup will acquire an American one. That's usually the other way around.
Yeah, it's
Not saying it's impossible, but that's the natural order of things.
Someday.
Someday.
Yeah. So do you have any closing remarks, any tips that you want to share before we round up?
Just that it's just one thought is that it's both hard to startup, raise funds. It's normal that it's hard, but at the same time you have to be realistic, which is you have to manage to balance realism with optimism, which is contradictory as a founder. But it's necessary that you hear, when an investor gives you a no, for example, you can, okay, I'm optimistic, maybe, I keep searching, and you should have this energy and this optimism. At the same time, you have to understand, why did he say no? What was wrong? What did I do wrong? Is it my pitch? Is it my fundamentals are bad? Wrong approach. So you constantly have to manage this kind of, and I see founders most of the time tend to be too optimistic, and they don't do the reality check enough. And this reality check is necessary to improve and adjust and iterate and improve again. So it's just, pay attention to that, and also work on yourself, read, accumulate knowledge, listen. We don't know much, and there's much to learn, and all the resources available. So grab it.
I agree. Thank you so much, Steph, for your time. I think we really shared some amazing tips, and everyone in the comments agree with us that they've learned a lot from this webinar. We really appreciate you taking all the time to speak with us. One last time, if you're looking for investors and you want an aggregated list, you can just go to openvc.app, and you can use your keywords to search and find investors that would be interested in your startup. If you need help with your pitch deck, Halisi Consults is here to help you with that. And yeah, that's all we have for today. Thank you so much, everyone, for joining. The video is going to be available for replay, so it's going to be up on YouTube till forever. So thank you.
All right. Thanks,
All right.
That was great. Bye-bye.
All right,
Bye, everybody.
bye.